yesterday, as I mentioned, we had a mixed picture in Europe as well, but that better opening on Wall Street and really seems to be driven by renewed M&A activity in the US at this point.
I think it is. I mean, certainly the US, some M&A activity really happening there. But if we just look at markets globally, almost any market you pick, I mean, the big trend that certainly I'm picking up from it, and it was today, the sell-off I thought would last a couple of days. Mid-afternoon today, the bears seem to have run out of steam, and the big picture seems to be that the bears have got no strength behind them, or maybe the other side of the coin, where the bulls are just massively strong. That tidal wave of cash we keep on hearing about that's sitting on the sidelines is absolutely propelling the bulls forward, and we saw today where everyone was expecting a really terrible day and we closed green.
Do you think the bulls are just looking for excuses here to push the markets higher at this stage?
Short answer, yes. I mean, we can make a fundamental argument for the markets being fairly valued, but the market. It was a much easier argument to make back in April, May, or June. Our markets have run hard. We need a lot of good things to happen to really justify this valuation. Even the green shoots we hear about, I think we've really run ahead of that. We're not looking for terrific growth next year globally, and frankly, we're looking at interest rates starting to pick up probably second half of next year. So really, it is almost a self-fulfilling prophecy. But right now, the point is, particularly if you're a short-term nature, the buying's out there. That's where the trend is. It's heading up. And if you stand in the way of this, it's going to hurt.
Well, although you say that, Simon, the all shares trading around 25,000, and it's really been trading around 25,000 for the past month or two, hasn't it?
It has, and I mean, if we look particularly at the top 40, the level we really need to focus on is 23,000. We need to see a strong break through that. We saw a break, futures close out, 10 days ago. We got to about 23.5, and then it's pulled back in the process there. We seem to be seeing some tiring at that point, but we're not at any stage, as I go back to, when the selling arrives, it's lacking aggression. Takes it back a little bit, and then the bulls come back into the party. I would have expected a stronger sell-off, a 5, 10, 15% sell-off, kind of get things out of the way and march on again. We're just not seeing that selling coming through.
I mean, do you think it'd be healthy if we saw that 10, 15% sell-off in the market?
Absolutely. I mean, from a trader or an investor perspective, nothing goes in a straight line. And I suppose, the alternative is that we consolidate, as we have been doing for the last month largely. We consolidate for a protracted period of time as sort of valuations catch up with prices. But I would much rather be in the favor of, you get some of the froth out of the market by taking it down 10, 15%, and then sort of re-go on that march again, and perhaps a slightly slower, less steep climb thereafter.
Just looking at some stats, Sam, the Dow had its best quarter since 1998, and over the past 3 months, it's now up 60% from its lows. I mean, do you think we're starting to see a bubble forming in equity markets at this stage? Short answer, I'm going to say yes. I mean, bubbles are easy. Once they start to pop, then we can identify them, NASDAQ and property and others. But if we look at what would be causing a bubble, it would frankly be the easy money out there. Loads of easy money that was thrown into the system to prop it up towards the end of last year and into this year. And we're talking trillions and trillions of dollars. And then further to that, that money which is out there, and a lot of it pulled out of markets to add to that, sitting in interest-bearing accounts and earning practically nothing. So that money's trying to find a home somewhere. And it, in a sense, I mean, is there a bubble like we saw in property in the US, like we saw in the NASDAQ in 2000? That could be it, but we're very, very early stages if that's the case. Well, just looking at some of that M&A activity, of course, we still have that Kraft bid for Cadbury hanging over the market. Xerox now buying affiliated computers for $6.4 billion. Abbott Laboratories buying another group for $6.6 billion. So quite big deals out there. And that would surely signal some confidence in the markets, as well as growing liquidity and access to funding. You're absolutely right. I mean, what we've certainly seen for all of this year and much of last year has been cheap valuations. And I think a lot of CEOs were licking their lips and saying, we would love to, but we can't. And you couldn't, simply because the money wasn't available and their confidence wasn't there. So I mean, what we're still seeing is those cheap valuations, but we're seeing that money starting to flow, which means that the money is now available and the confidence eking back in. And I think one of your first comments we started chatting was that this merger and acquisition activity really is feeding into the market and giving it a signal. And that signal is that sort of level of return to normality. Again, I suppose, if you will, a bit of a green shoot type of environment, which is giving the market some boyishness.
Well, just following the rapid rise we've seen in local stocks, where are you seeing value? I mean, where are private smaller investors and private investors finding value in the markets at this stage, or is it just a trader's market?
It's a bit of a trader's market. I mean, the easy money, make no mistake, was back in March and April. Easy money is gone. I think some of the folks are looking at the commodities. We had the commodity stocks. We had the strong pullback in commodities in both platinum and gold, and they both seem to have held. Oil, jewelry still out, and certainly I think the view is it's probably going a bit lower. But again, if we turn broader to the non-precious, the coppers, the nickels and the like, I think a lot of the view is there. We've seen the pullback both in the commodity and the share prices, and I think that's generally the view people are looking at for the next move. Financials probably fully priced, and I think in some of the industrials people are looking to pick up some there, and then again, depending on where we think we are with recession, some of the retailers. But I think the short answer there, commodity stocks.
I mean, you mentioned retailers. Would we be looking at perhaps the interest rate sensitive retailers at this stage? Because of course we know the cash retailers did very well earlier in the year.
That's exactly it. You know, your base retailers have done very, very well, and I think the eye is now turning to that next level of retail, and I'm thinking here of the companies such as maybe Truworths, maybe Woolworths and the like, Foschini's. We can start seeing some activity start happening there as the consumer confidence starts to come back, and we'll get some indicators of that with data coming out later in the week. Public sector credit extension will give an indicator there. We've already had some indications from the companies themselves saying that they're seeing a bit of activity returning to the businesses as consumers start getting a bit more flush and critically a little more confident about the future. I think that's the next sector which is really going to start moving. It might be a little bit early in that stage, of the process, but certainly people are starting to look around those.
Of course, we know there was a negative reaction to some of that US data that was out on Friday, the durable goods and the new housing data specifically. We have PMI data out this week. We also have the ISM coming out of the United States. Do you think they're going to be key really to guiding the markets about this recovery?
Short answer, absolutely. In South Africa, we're looking for that move to at least be, well, to move off the very low 39 and change. We're not going to get above 50 anytime soon, which would indicate that at least we're seeing expansion. I think turning to the US and the like, really that number's above 50. What they're looking to see now is that trend continuing, or is there a bit of flattening, or for worse, some pulling back, just to give an indication. But we've also got to differentiate, and one of your guests was talking about it about half an hour ago, the business confidence versus consumer confidence. And I think they're very, very different beasts. And I'm suspecting that consumers, whilst we're easy to rush out and spend and the like, I think they're a little bit shell-shocked and perhaps going to hang back a little bit more in terms of paying off debt and before they start entering more debt.
I mean, what's going to guide the South African market from here? We know that most of the results are out of the system now. We have some dribs and drabs of economic data coming out. Are we really just going to take our cue from what Wall Street's doing at this stage?
I think Wall Street, I think the economic data in South Africa is a lot less frequent than it is in the US. They've always got data coming out. We're going to be looking for things such as GDP, which is still a way off to see, are we out of recession or how bad it is and the like. And we will look at to a degree. But as you said, the results are out of the way, so we need to turn our eye. And it's going to be Wall Street, it's going to be Europe to a degree, particularly the FTSE, to try and get some indications there and see globally how's the recovery doing. South Africa can do all right. We can pick up, we can grow, but to really get running, we need the global economy up and running at the same time.